Hello and welcome to Moneycontrol. You've tuned into Earning Express and I'm your host Nickey Mirchandani. Shares of Honasa Consumer, the parent company of direct-to-consumer D2C personal care brands such as Mamaearth, the Derma Co, BBlunt, soared as much as 10% in trade today after reporting in the December quarter scorecard. But how do the numbers actually stack up going forward? What's the demand situation looking like? Let's get all the answers from anpreet Sohi, who's the Chief Finance Officer of the company, joining us here. Afternoon there, gentlemen.
Hi, good afternoon. Thanks for having me.
Pleasure, pleasure. Let's talk about your margins bit straight up. For 9 months FY24, the company has recorded a margin of 7.1%. versus a nearly 1 to 2% growth that was clocked in the previous 2 financial years as per the RHP. What explains this sharp jump? How sustainable are these numbers?
No, sure, absolutely. I think that's an important aspect of how we are sort of focused on building our business. So as we scale, very clearly we want to scale efficiently and hence focus on ensuring that the bottom line growth is faster than the top line growth. Now, as you see, our operating margins for during the year, in fact, for first 9 months, and how it has sort of stacked up quarter on quarter, we've been able to get almost 400 bips margin expansion, and this is absolutely structural, clearly led by A&P marketing spend efficiencies that we see across our largest brand Mamaearth, and as well as our younger brands. As they've scaled efficiently. So we've been able to get better returns on our investments on the brand side, and I think that's one of the biggest levers for us in terms of margin expansion. And of course, at the pace that we're growing, at the scale that we've achieved, there is certain leverage in the other OPEX items in the P&L. So I think that's how we've seen the margin picture unfold. Going forward, I think we have clear sort of levers to ensure that we continue this margin expansion story into next year as well, and we'll focus on executing it and ensuring 100 to 150 bips kind of margin expansion as we look ahead into next year.
Margin is sustainable for FY24 also?
I think I probably missed your question. You're saying, are these margins sustainable for the rest of the year?
Yes.
Yeah, I think we're confident that we should be able to sustain the current set of level of margins for last quarter of the financial year.
Okay, could you give us a margin split across your diverse portfolio? Mamaearth, Derma, Ecologica, beg your pardon, BBlunt, Dr. Said, Ayuga. Can you give us a margin split there?
So it's difficult to sort of talk about specific brand level margins. But clearly what I can talk about is, let's say Mamaearth, which is the largest part of our portfolio, contributes to close to 68-70% of our business. That is the most profitable brand given its scale, given its sort of timeline in the journey that it's been. It's a 7-year-old brand now. It's profitable. It's a double-digit kind of a operating margin profile for Mamaearth. Our second largest brand, Derma Company, which we actually announced last quarter, achieved a 380 crore kind of a annual run rate, is actually turned EBITDA positive for the entire year. And of course, the other brands are in the invest phase. They are obviously, younger brands. Some of them are less than 2 years, in terms of when they were launched. And they are in investment phase. We are sort of investing behind the brand. And as you know, consumer brands obviously have certain timeline and journey as they sort of scale, and at a certain scale threshold, we expect them to also break even over next 2 to 3 years.
Okay, so help us understand. Your presentation clearly talks about Derma Company being EBITDA positive for the quarter, and also the comment that you just made right now. But help us understand what is the status for Mamaearth, Ecologica, BBlunt, Dr. Said. When are these expected to turn around? And how quickly?
Yeah, so I think what we can say is that, kind of sort of brand building playbooks that we have, we initially launch all our brands on, digital platforms, on online marketplaces, and also our D2C platform to start with. We obviously try and understand the traction some of these brands are seeing, we're able to get initial first-party customer-level data. We tried to understand the sort of how the consumer is interacting with our brands and proposition. And as we scale them over time, we also scale them into e-com marketplaces first, and then thereafter, beyond a certain threshold, we take them into offline platforms, right? Which is our offline distribution that we are scaling through Mamaearth. Now, in this journey, as the brands scale, we will see some of these brands breaking even. Like I mentioned earlier, Derma Company, which is at a 380 crore annual run rate last quarter, it broke even for us and is a bit positive. So I think also what we're seeing is that our younger brands also scaling faster than, let's say, to reach a certain scale threshold. They've scaled faster than Mamaearth. Some of them have scaled faster than Derma Company. And as also on the efficiency front, they are doing faring better. So of course, I think it's difficult to clearly pinpoint a timeline, but we are the direction and the traction that we're seeing in these brands. We are hoping that all our current brands that are in the market today should see positive EBITDA margins over the next 2 to 3 years.
Okay, Mr. Sohi, okay, if you can tell us which is the company which will break even next off the lot. Sure, given the kind of acquisition, the scalability and the timeline, I'm sure you'd be able to put at least a finger to one of the companies which you think will break even sooner than the other one. Which one would that be?
See, these are our brands and not companies. Just to clarify, so we are a house of brands.
Sure. These are some of them are also inorganic, so that's why I use the word companies. But sure, they're your brands now.
Yeah, absolutely. So I think we are hopeful that from a break-even perspective, brands which are around 3 years to 4 years from its launch, most of the brands should break even, like we've seen in the case of Derma Company. And Aqualogica has been in the market for close to about 2 years. BBlunt we've acquired about 1.5 years back. Dr. Sheth is another brand that we acquired about 1.5 years back. Clearly, Dr. Sheth, Aqualogica, all are 100 crore plus brands. Aqualogica, in fact, is a 200 crore ARR for us. So we see, I think, Aqualogica and Dr. Sheth brands who are likely to sort of break even over this sort of trajectory that I spoke about, which is next 2 to 3 years. So I think when you're building and investing behind brands, it's very difficult to say pinpoint X month the brand will break even. Directionally, we are very confident. We're seeing traction. We're seeing efficiency. We're seeing better return on our investments as these brands scale. So there is clear direction. And like I said, our focus is that we'll continue to incrementally generate 100 to 150 basis points of operating margins year on year. I think that's something that we're focused on, and that will be sum of parts in terms of how Mamaearth brand will scale, how it will sort of generate unlocking of certain margins, and how our younger brands will scale and unlock margins. So it will be sum of parts helping overall business achieve 100 to 150 bips margin expansion year on year.
Mr. Sohi, just to get that right, Mamaearth is break-even right now because we couldn't have a further segmental breakup. So because it contributes to roughly 60-70% of your top line, if it's EBITDA positive here, and if not, by when can we expect it?
No. So I think what we need to understand is that we are at a 7% EBITDA margin. Right? So at overall company level, we are 7% EBITDA and obviously a margin which is improved by 400 bips. It's a structural expansion, and we are confident that it will sustain at this level for this year. And then from that base, we are sort of focused on generating levers which give us 100 to 150 basis point incremental operating margins year on year. Now, if at an overall level we are 7% operating margin business, Mamaearth contributes close to 70% to our business. So Mamaearth, of course, is at a higher EBITDA margin, which is in our view, plus double-digit EBITDA margin, operating margins right now, right? Second brand, Derma Company, is break-even during the year. And then the other brands are in investment phase. And the sum of parts operating margin for our business is at 7% today.
Okay, so Aqualogica and Dr. Sheth, the trajectory that you've given is 2 to 3 years. BBlunt and Ayuga, according to you, could perhaps take a little more time because they're recently acquired.
Yeah.
Okay, all right. What was the growth rate of Mamaearth during Q3? And also let us talk about how is the demand situation typically stacking up for you in this quarter and for the year put together. How different is the scenario? Where's the pain? Which pocket is essentially contributing to that exponential growth? Tell us more about it.
Sure. No, I think, third quarter, we've seen some softening of demand. I think there are challenges in the market. What was impacting the rural markets, and we've been seeing a rural slowdown play out over last 2 to 3 quarters. Similar sort of, we're seeing, that kind of trickling down into urban markets as well. And there is a certain level of pressure in terms of consumer demand that we're seeing in the urban markets as well. The festive season didn't really play out well for e-commerce marketplaces. We're also seeing certain level of pressure on GT offtakes during the third quarter, also resulting into higher inventory and resulting into working capital crunches for a distributor ecosystem. So I think that's the broad background in an environment that we are operating in. Like I said, we continue to focus on ensuring that we continue to grow faster than the markets, at least 2 to 2.5 times faster. And that's the environment, which is challenging us. And as we get into Q4, we see, I think in the near term to mid term, some sort of a consumer demand pressures impacting most of the consumer companies. It was obviously more pronounced for the incumbents basis the rural slowdown. And now, of course, the portfolios which are more urban focused are seeing an impact starting Q3. And hopefully this will be short-lived and we'll be able to come out of it, as winners in terms of how we've been able to capture higher market shares over time across our brands, across the categories. We continue a similar trajectory as we enter Q4 and beyond.
Okay, with that being said, and the demand situation being a little bit more challenging, 28% year-on-year growth was the number that the company captured on top line. Do you expect some amount of moderation to come through in the Q4?
Directionally, I would say yes. I think you can't fight the demand environment beyond a point, and I think that's something which we are seeing play out. So there will be some level of softening in terms of how we see a top line growth pan out for next 1 or 2 quarters.
All right, point well taken. Typically, where do you see more softness? Which of the brands essentially you think will perhaps see a little more softness as compared to others? Is it Mamaearth only?
I think consumer demand is it will be impacting across brands, but I think what's important is given the penetration of Mamaearth as a brand, it's also fairly well distributed on the offline side. Given the consumer adoption that the brand Mamaearth has, given the household penetration that Mamaearth has, I think there we'll see a little bit of this playing out a little more. Whereas our younger brands are fairly young and they are in the market share. They're also focused on introducing newer categories, and hence I think the impact there could be limited. So that's how we see this piece unfold for us.
That still didn't answer my question. Is Mamaearth the pain point in the Q4 where the demand moderation is likely to happen because it contributes 70% of your revenue? So clearly, is that the pain point in this quarter also?
So I think I wouldn't say it's a pain point. Very.
Or let's just say softness of demand will perhaps hit Mamaearth more, given that it's a bigger contributor to your revenue.
I think it'll be a sort of similar impact across brands. What I wanted to mention was that given the presence of Mamaearth across channels, given the households Mamaearth is present in, I think we will be able to see a more sort of democratic sort of impact there, given its penetration. Younger brands, given the penetration, they're still young. They are on online platforms primarily. They are in categories and propositions which are new or are getting lapped up by the consumers. There, obviously, it's a consumer demand scenario, right? It will impact all the propositions and brands. But given they are still young and small, we'll probably not see as much sort of the impact playing out there. That's what I was trying to run.
Okay, your advertising expenses at the time when we were having discussion with Varun and Ghazal during the time of initial public offering, highlighted the fact that seems to be a little higher as compared to even the industry leader HUL. But for the quarter, it seems to have moderated a little bit, 33.9% in quarter 3 versus 34.3% in the corresponding quarter of the previous year. What number is sustainable going forward? Can we expect more moderation to come through?
Yeah, so I think let me first clarify this. This year for first 9 months, we've seen almost 200 basis points optimization in A&P spends on a year-on-year basis. Of course, year-on-year for the quarter, it has sort of moderated, in line with what you mentioned. And also, this number is a sum of parts of all our brands, right? So, Mamaearth, which is the largest brand, is probably at a lower ad spend, and younger brands, which are in investment phase, are at a little higher ad spend. Having said that, like I mentioned, as we've seen scale up of all our brands, we are clearly seeing A&P as a key lever for sort of ensuring that our operating margins continue to improve year on year. And for that, A&P will be a key sort of a lever for us in terms of leverage, in terms of ensuring efficiencies. And this number will continue to sort of come down as a percentage of sale year on year as we continue to sort of scale and increase the distribution for all our brands.
Okay, so on sustainable basis, can we expect a number which is a little sub 30% anytime soon?
No, I think we'll have to look at it the other way around. What we're saying is that, firstly, we are a beauty and personal care company. I think it's difficult for us. Which ideal benchmarks are not the incumbents which have a multi-category portfolio. I think the good benchmarks for us are companies like L'Oreal, who are obviously not listed in India, but their financials are available. Also, if you benchmark global beauty and personal care companies, their reinvestment rates are as high as 25 to 30%, right? What I'm trying to say is that every year as we scale, we'll unlock operating margins of 100 to 150 bips. Majority of this unlocking will happen through our A&P spend. So yes, you will see directionally our A&P spends getting optimized, reduced as a percentage of sale year on year, and this will play out across brands. And as sum of parts, this will at a portfolio level come down each year on year.
Okay, your gross margin dipped as much as 80 basis points sequentially and 200 basis points year-on-year basis. What explains that?
Yeah, so I think that's there are if you actually look at like for like, we have in the base we have a discontinued operations of Just for Kids, which is Mamaearth, and it is a service business, and hence most of its cost is captured in the payroll line item, and hence its gross margins are compared to product business is fairly high. And if you exclude that, because it got discontinued and it is in the base, if you exclude that, like for like, the gross margins are broadly in the same range. There's a difference of only 15 to 20 bips if I do a like for like comparison, and that's primarily because there is some change in the channel mix and category mix that happens in Q3. At a 9-month level, what we can say is it's broadly flat if I exclude the discontinued operations of Mamaearth in the base.
And including Mamaearth, what's the number looking like?
So Mamaearth is a discontinued operation in the current financial year. Mamaearth is not there.
Sure. So no impairment related to goodwill or any other tax, perhaps adjustment in the financials for the quarter, right?
No. There's nothing.
Okay.
All of that is already in our history. Last year it was all done and finalized.
Okay, all right. Let's talk about your target revenue from the new products. Help us understand, are you looking out for any more companies that will in turn turn as your brands? That's one. Any more targets that you have perhaps identified? If yes, within that target revenue from the new products right now?
Yeah, so I think there's nothing on the on the table in terms of new acquisitions as such. There are of course some white spaces that we see in the market, and we'll be sort of focused on ensuring that we launch and enter those white spaces over next 2 to 3 years. There's nothing that is concrete and we're able to announce right now. Of course, new products and innovation is key aspect of our business. We continue to focus and ensure that innovation is key driver for our top line. We in fact launched almost 100 plus products during the year in the current financial year, and we continue to focus on launching them across our key categories of face, hair, and color cosmetics. In fact, color cosmetics, we were able to enter that category through Mamaearth and scale it to almost 150 crore annual run rate. So I think that shows the versatility of our brand, Mamaearth, its ability to enter new categories and scale. So I think that's a very encouraging sign for us.
All right, you can. Okay, just last question. I'm sorry to squeeze that in. I hope you're doing fine. But just any more targets in terms of the acquisition that you are looking at, which you can perhaps outline at this point of time? Do you want to sip on some water?
Yeah, I'm just going to do that. Thank you so much.
Yeah, that's perfectly fine.
Sorry for that.
No worries. Please tell us anything that you've identified, the company has identified in specific pocket that you'd want to talk about, or any company that you think, perhaps not the name, just in terms of business interests that the company would be looking forward to?
No, I think we are focused on sort of building and scaling our brands. We have 6 brands in the portfolio. We also see certain white spaces in certain large key beauty and personal care categories where we'll be sort of launching our own organically built brands. As of now, we continue to, of course, scan the market, but there is clearly nothing on the table. There is nothing that we think is exciting enough for us to evaluate. That's broadly where we are. Clearly focused on our current sort of set of brands in our house of brands portfolio, and we continue to focus on their scale up. And of course, like I said, watch out for this space in terms of how we look at launching incremental propositions in certain interesting categories for us going forward over the next 2 to 3 years.
That's precisely what I was trying to understand, Ramanpreet, which organically also, if you're looking at it, which is the category that you're chasing or you're capturing, by when they're expected to be launched, what sort of revenues, just give us a ballpark estimate. We're not holding you on to it, but just a ballpark estimate or a direction would work.
Yeah, so I think when you look at a new proposition or a brand, very difficult to give any estimates on how the brands will scale. Obviously, we've been able to now scale from 1 brand to 6 brands. There is an execution history that we've been able to sort of set and demonstrate over time. I think as a interesting category for us, which we're watching and tracking closely, is the color cosmetic space. Also, a lot of confidence comes to us given how we've been able to scale that category with Mamaearth, like I just mentioned sometime back. So that gives us a lot of confidence in terms of launching our own brand, in the 10,000 odd crore color cosmetics, performance-driven color cosmetics space. I think that's probably what I can talk about as of now. Of course, as things get executed over time, we'll obviously closer to time give more clarity.
All right, sir, we'll leave it at that. And thank you so much for taking out the time and having this conversation here right with us.
Thank you so much. Thanks for having me.
Pleasure.
Have a good afternoon.
Well, with this, it's a wrap, and goodbye from the entire team who puts this piece together for you. Hope you enjoyed watching it. Stay tuned in for more.